we think of you as our equity expert here. So tell me what's going on with these markets. They just seem to go one direction pretty much, and that's up. Should we be getting worried?
Yeah. Well, David, great to be here. I'd say the risk-reward from our perspective has gotten more balanced with this rally we've had. Essentially, we went into Q3 with the view that S&P 500 at 5,600 by year-end made some sense. We argued that valuations around 22 times were sustainable. We're now at 23 times. We've argued that earnings growth under the surface for the S&P 500 is in good shape. That came through with Q2 reporting. Bigger picture, you've got three forces at work in equities right now. One is the AI tailwind that's been supporting the mega cap growth part of the market. The other is soft landing conviction, yes or no, and it's been more yes of late, aided by Chairman Powell's commentary at Jackson Hole today. And then the third element is the election impact, and that's, I'm going to say, a little bit more of a tail risk that's been pushed aside for now as we continue to kind of work our way through the aftermath of the DNC.
So let's go back to the first one there, the AI momentum, if I can put it that way. We've got NVIDIA earnings coming up next week. How important does that make something like NVIDIA's earnings, indicating whether we're keeping the momentum or losing some of it?
Well, the starting point is you look at where we ended the first half. The S&P was up about 15%, and we'd attribute about 5 percentage points of that move to each of NVIDIA, the rest of the Mag 7, and the other 493 within the S&P. So NVIDIA has been an important contributor to the S&P 500 move. Obviously, it pulled back from mid-July into early August and now has recovered. So I'd say absolutely yes. The way they report, the way they position themselves in terms of future growth expectations is going to have an important influence on its stock, but also on the balance of the Mag 7 and this AI play.
Well, it's interesting, as you said, it's sort of a third, a third, a third. But the third was actually the rest of the pack. Are we starting to see some broadening out now? Because for a long time we were worried that it was such a narrow driving of the S&P.
Well, it's fascinating. When you look at the way Q2 results have finished, okay, and we're pretty close. We still have to get NVIDIA and a few others to report. You actually had that Mag 7 component growing earnings in Q2 by roughly 38%, which is pretty astonishing, okay? We think there's some persistence of that in the second half. Interestingly, the other 493 grew earnings in aggregate 5%. Doesn't sound like much, but that's the first quarter of the last 6 where we've actually gotten a positive earnings growth dynamic out of the rest of the 493.
How are we positioned going into the second half of the year?
So we think we're pretty well positioned from the following perspective. On the pullback, we were very comfortable re-engaging in that mega cap growth cohort on this mantra that growth is defensive as we navigate signs of economic weakness, which is ongoing. But more directly, we put our major sector focus on those areas most likely to benefit from the Fed pivot, which apparently is getting closer and closer. Obviously, September coming up. So we've been quite constructive on areas such as consumer discretionary, financials via the banks, and then interestingly also through the real estate part of the S&P.
So, Scott, talk about that second factor you talked about, which is the possibility of recession. There was a time that a lot of people, including Larry Summers, were really quite worried about a recession. That seems to be subsiding. Where is Citi at this point? Where are you?
Well, my economic colleagues are still of the view that we're facing a second half recession risk. Okay, so the way they're manifesting this is through a Fed funds rate view, which is essentially that we can get as much as 125 basis points of cuts between now and year end. The focus here becomes on labor. Okay, now we know we had some BLS revisions this past week that are their own topic of discussion. But the important point here is that we're seeing signs of weakening on the labor front. And if that were to sort of steamroll, if you will, then you put yourself in a little bit more precarious situation versus this soft landing scenario. From my perch, we're a little bit more balanced on this. We are seeing some softening in labor. We have to be attentive, though, that what comes with this is the ability to get to this Fed pivot without the risk of having that much of an earnings drawdown versus history. So all told, we walk away pretty constructive here that the S&P 500 is going to be able to navigate any ongoing economic weakness. And then in our back pocket, we have the potential for an easing Fed as we go into the end of the year to begin to set up for recovery out the other side.